Ladies and gentlemen, good day and welcome to the Q4 CY21 earnings conference call of Schaeffler India Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Gauri Kanikar from Schaeffler India. Thank you, and over to you, ma'am.
Thank you, Margaret. Good afternoon, everyone, and welcome to the fourth quarter and full year earnings conference call for Schaeffler India Limited. Today we have with us Mr. Harsha Kadam, CEO, Schaeffler India, and Mr. Satish Patel, Director Finance, CFO, Schaeffler India. Mr. Kadam will take us through a short presentation on our results, after which we open the floor for questions. Thank you, and over to you, Mr. Kadam.
Hello, good afternoon to everyone. A very warm welcome to our earnings and conference call here. I'm Harsha Kadam, the CEO, and along with me is...
Hello, I'm Satish Patel, CFO of Schaeffler India Limited. Welcome you all.
I would like to take you through our quarter 4 performance as well as the calendar year 21 performance. So I move to the slide number 2, which is going to talk about the agenda for today's meeting, and I will cover the presentation under 3 broad areas. Firstly, updates on the industry and the economy. Secondly, an overview of the Schaeffler India quarter 4 and the 12-month 2021 performance, followed by a quick summary of our value creation initiatives undertaken over the year. I move to the next slide, which is about the economy, and while the outlook remains positive, the GDP growth for Q3 2021 was projected at 8.4%. Having said that, the Indian economy is expected to grow at 9.2% for the entire year after contracting in the previous year. While the index of industrial production, the year-to-date registered performance was 15.2% compared to a degrowth of 13.3% same period last year. However, it is expected that some of the sectors like mining, manufacturing, which grew well 16%, and electricity grew up at 9.4%. We would continue to see some traction across some of the sectors, implying that the overall economic activity has recovered past the pre-pandemic levels. We are also seeing some new third wave in the form of Omicron, which began to emerge in the last month of last year. Although it appeared to be a milder version, but definitely it did have some impact on the economic activity in the country. Also, what we see coming back, making a comeback, is the inflation, and we see that the consumer price index, which is at 6% for the month of January 2022, and at the back of increased fuel prices and supply chain disruptions, we believe that we are seeing some inflationary trends on the horizon already. So we continue to see the index of industrial production and the 8 core index growing, albeit at a slower rate than the previous quarter, but we believe that the growth momentum still will be sustained. I move to the next slide, which is going to talk about some of the core sector performances. And here too, what we see is the growth momentum, which is continuing to be visible in the industrial sector. Cement production in the country, as you can see, last year grew by about 21.5% when compared to the previous year, and by percentage of weight contributing about 5.4% to the GDP. Look at the steel production, and that too grew at about 18.4% when compared to 2020. Mining and coal grew at about 6.3%, and surely electricity, as I already said, about 9.2%. So some of the core industrial sectors have shown a good recovery and a stabilized growth rate were visible towards the second half of last year. I move to the next slide, which is talking about the automotive production. Despite the challenges that were faced during the year, we did see some growth in the sectors, some of these sectors in quarterly manner. The sector which actually did well for the entire year, more or less, was the commercial vehicle sector. So when you compare the commercial vehicle sector Q4 performance over the Q3, the commercial vehicle production numbers were 6% up. Same was the case with the passenger vehicle sector. In spite of the chip shortage, it did manage to grow 1.9% over the previous quarter in 2021. While the tractors and the two-wheelers were two sectors which were severely impacted, and we saw some degrowth. The tractor degrew by 31.4% when compared to the previous quarter. The two-wheelers degrew by 11.1% when compared to the previous quarter. So all in all, when we look at the vehicle production in the country for the fourth quarter of last year with the third quarter of last year, we saw a degrowth of almost 5%. Compare that with the Q4 2020, also we saw significant drop in the production numbers. Passenger vehicle was down 6% when compared to Q4 of last year, and the tractor was down 27% when compared to Q4 of 2020. While the commercial vehicles continue to still show some strong recovery and growth. Hopefully with the PLI scheme that is now being pushed across very aggressively to boost the domestic manufacturing effort, we definitely hope to see some recovery in the automotive sector going forward as well. I move to the next slide, which is talking about the union budget that was passed recently on the 1st of February. And in a nutshell, the summary is that the budget entails a long-term vision of the country with key focus areas to stimulate and sustain the growth rather than the short-term tax proposals and subsidies. Some of the key announcements impacting the automotive and the industrial sectors are the significant increase in the capital expenditure to boost infrastructure, and also the aim to cut down the logistics cost from the current levels of 8 to 10% to 5% of the GDP. Or not to mention, of course, the continued thrust on the domestic manufacturing with a lot of localization initiatives that have been encouraged. Another focus area in this budget has been the climate change and clean technology area, wherein which is mobilizing the battery swapping policy and also the green energy of hydrogen as such, impetus being given to the solar and the wind to increase the installed capacities to 280 gigawatts. So there's been a lot of focus on the green energy side, clearly in line with the government's commitment to decarbonize the economic activity in the country. Look at the regulations and the regulatory changes. Surely we will be going through another change in terms of the emission norms with the CAFE norms that is getting implemented now. And also there is some talk of the BS6, Bharat Stage 6, Phase 2. And hopefully this is going to open up more opportunities for technology products and players like us who can bring value offerings to the market. Moving on to the next slide, which is where I would like to throw light on the performance in the Q4 as well as the 12-month period of 2021. I go to the slide on the Q4 2021 performance. All in all, the fourth quarter of the year, we were able to post a strong, robust performance, and I'm pleased to say that we delivered healthy revenues and record profitability gains for that quarter. So having said that, the revenues stood at 15,232 million rupees, which was a clear 19.6% sales growth compared to Q4 of 2020, and compared to the previous quarter of Q3, which was 2.4% better. Looking at the EBIT margin, and we were able to deliver a robust, healthy EBIT margin of 16.1% for the quarter, and when compared to the Q4 of 2020, where we had delivered 14.2%, and an EBIT level of 245 crores that we were able to deliver within the quarter. The profit after tax margin stood at 12.5% for the Q4, while the same period last year was at 11.1%, and for the Q4 we delivered 190.6 crores, the profit after tax. Having said that, the free cash flow was another area where we took some aggressive steps to bring cash into the company, and we were able to bring in 185 crores into the system, and which was definitely lower than the Q4 of last year, but certainly helped us to shore up cash into the company. And also we would like to share that the board of directors recommended a dividend at 16 rupees per share, per equity share, at a face value of 2 rupees, with a payout ratio of 40%. And as we enter 2022, we also saw the emergence of the third wave, which could effectively mitigate the risks. Although we have gone ahead and ensured that all our employees are vaccinated, we will continue to see some headwinds due to the semiconductor shortages as well, and some input cost pressures that we were facing. One other milestone that we crossed during the year was the signing of the Memorandum of Understanding with the Government of Tamil Nadu for our new project plant expansion at Hosur. And these were some of the highlights, and one low light which we see that some challenges definitely exist on the horizon. I move to the next slide, and here I would like to talk some of the business wins we were able to secure in Q4 of 2021. And these business wins were in all the areas of automotive OEM space, the automotive aftermarket space, as well as the industrial space. Now, talking about the automotive OEM space, some of the key products that we were able to bring out were on the dual clutch transmission damper, the clutch applications, as well as the cam phaser applications for the engines, and also the wheel applications or wheel bearing applications for the passenger car segments. We were able to secure new businesses in the quarter, and resulting in significant gains of the business, which is now starting to pick up, and we will see the full realization of these businesses in the years to come. Having said that, on the automotive aftermarket as well, we continued on the journey of adding new product lines and expanding our product portfolio. Some of them were the introduction of the clutch for the light commercial vehicle segment. Also talking about the timing kit and the front-end auxiliary drive systems for the passenger vehicles, as well as some of the range extension products like shock absorbers that we were launched in the Q4 of last year. Coming into the industrial space, we had some significant gains coming, on the back of some wins from the mining industry, the construction equipment industry, as well as some significant gains coming in our digitalization effort by way of condition monitoring equipments, where we bagged orders which we will be servicing in the year 2022 and 2023 as well. Not to mention, of course, the two-row cylindrical roller bearings and spherical roller bearings orders for the raw material and metal sector. Having said that, I move to the next slide. One of our strongest performance has been in the export area, and with a spate of products that we have started to relocate into India, obviously our strategy on export progressing well. While we are committed to continue to make the necessary investments in the capacity, capability, and competence build-up, we would also like to leverage the cost competitiveness of the country to grow the business outside of India as well. So having said that, a number of product lines that we have started to bring into India, starting with the angular contact ball bearings and the two-row cylindrical ball bearings and the two-row taper row ball bearings for various sectors. We have also started to expand our footprint clearly into Asia Pacific region, and we saw some significant gains in the businesses within the quarter in the Asia Pacific region as well. And we have also started to now extend our market in Europe as well as in America, leveraging the cost competitiveness of the country. To enable that, we speed up the time to get the products to the market. We also have started to augment our R&D and computer-aided engineering capabilities within the country. We have built in more competencies into the system to enable efficiency in the entire product development process as such. Not to mention, of course, design and validation, which would call for infrastructure by way of test trips, too, are being addressed so that we become self-contained in our setups so that we can complete the homologation of the products that we deliver to the export market as well. All in all, 2021 for the entire year, our exports grew by 70%, clearly the highest growth that we have seen being in the export sector. Moving on, I now come to the revenue from operations, and as I said, we have been able to sustain robust performance quarter on quarter. And as you can see, while for the quarter 4, we were able to deliver 1,523 crores, which was 2.4% better than the previous quarter. But compared to the same quarter period of 2020, it was 19.6%, definitely better. So having said that, the entire year 2021, the total revenues stood at 5,560 crores compared to 3,762 crores in 2020, which was rightfully a truncated year due to the pandemic. So where did the businesses come? And as you can see the bridge below, the majority of the business came from the exports, which was clearly 804 million coming out of exports. In this industrial too, grew on the back of our distribution business or the aftermarket business in the distribution and the wind sector, predominant growth there with 943 million. The automotive aftermarket too grew by 391 million, and the automotive OE technology, as you can see here, 356 million within when compared to the Q4 of 2020. All in all, strong growth in all the business areas, as you can see on the right side, the key aspects. The sales stayed resilient. However, we began to see some softening of sales in the auto technology area in the fourth quarter of 2021. As you can see, compared to 2020, the growth was only 6.7%. Fundamentally, this is attributed to the semiconductor shortage that the entire automotive industry is going through, which definitely had impact on our business as well. The automotive aftermarket, we were able to project a strong growth as well in double-digit. Industrial too, a strong double-digit growth when compared to the same period last year. However, the exports, as I said earlier, we had a phenomenal growth story there to tell. And at a quarter-on-quarter level, 61.6%, and year-on-year level at 70% growth has been a very good performance. While we continue to, work well on the market, we also ensured that the plants were back to the normal capacity level, and we had a good capacity utilization towards the second half of last year. And we continue to keep the balance between the automotive and the industrial space that we have while we continue on our journey to grow the export market. I'll move to the next slide, which is talking about our EBIT margins for the quarter, which was very robust at 16.1%, as compared to 14.2% in the corresponding period of the previous year, and 14.9% in the quarter compared to the previous quarter. Having said that, in absolute terms, the EBIT stood at 245.1 crores, and the volume gains coupled with sustained countermeasures that we have put in place ensured a robust profitability development here. Also, our strong processes helped us to manage the cost as well as mitigate some of the risks across the value chain. And based on that, we were able to deliver a profit after margin of 12.5% for the quarter versus 11.1% for the same period of the previous year, and 11.5% for the preceding quarter that we went through. I move to the next slide, which is throwing some light on the working capital and the free cash flow. We continue to keep the focus on these parameters, and I must say that we saw some improvements in the fourth quarter with our working capital, stood at 18% of the sales, which was better than the previous quarter, which was at 19.3% of the sales. As well as we continue to judiciously look at our investments last year, and we are consistently at about 3.5% of sales coming for every quarter across the year. And the total capex for the year was at 192.9 crores. And when looking at the free cash flow, after the wave 2 that we went through in the second quarter, where we had a negative cash flow, we bounced back. And while in the third quarter, we were able to bring in 209 crores. And I must say we were able to bring in another strong, in the third quarter, 108 crores. We were able to bring in 185 crores in the fourth quarter of 2021. Moving on, the key performance indicators. So as you can see here, while the revenue growth was at 5,560 crores, which was 47.8% better than the previous year, which of course was a truncated year, and we saw a 13.7% degrowth due to the pandemic in the year 2020 when compared to 2019. The EBITDA margin in the fourth quarter stood at 19.4% when compared to the preceding quarter, which was 18.2%. At an annualized level, as you can see, we ended the year with 17.9% EBITDA margin, and that when we compare with the year 2020 was 14.4%. And the EBIT margin finally for the quarter 16.1%, and the preceding quarter 14.9%, and for the full year 14.3% versus the 9.2% in the year 2020. That brings us to the earnings before tax margin at 16.9%, which compared to the preceding quarter, which was 15.4%, and at an annualized level of 15.2% compared to 2020, which stood at 10.6%. So all in all, the profit after tax margin, as I already shared, we were able to close the quarter at 12.5% and at an annualized level at 11.3%, while the same period in 2020 was 11.5% for Q4 and at an annualized level was 7.7%. Moving on, some information on the stakeholder value creation, the actions we took. Let me start first with the corporate actions that we took. As you all know, we had already initiated in the last quarter board meeting, we had put the proposal up for approval, adding on to our value creation. One of the corporate actions was the 5-for-1 stock split, which we had initiated in the last quarter. Finally, that has been now completed and approved by the board of directors on 28th of October 2021 and approved by all the shareholders by 19th December 2021. And the stock split came into effect from the 9th of February 2022. And I would like to stop here and take the opportunity to thank all our shareholders for having supported this decision and approving, giving us your formal approvals. Thank you so much. With that, I'd like to move on to the next slide, which is one more corporate action that we did was on the dividend payout that we enabled in this quarter. And as you can see, the board of directors of the company has recommended a dividend for the year on December 31st, 2021 at the rate of rupees 16 per equity share of face value 2. And, as you know, before the stock split happened, if I were to compare last year, the performance was, the dividend payout was 38 rupees per equity share at a face value of 10. Now, having said that, This is another step in our endeavor to create value to our stakeholders, and we will continue to bring more value as we move forward. Having said that, it's important that we have a very clear roadmap and the journey ahead. How are we going to do it? And I would like to take the opportunity moving to the next slide, which is going to talk about sustainability focus. Schaeffler, as a company, sustainability plays a key role in implementing our corporate strategy. And the decarbonization of the Schaeffler Group by 2040 is a top priority for us. Through our defined targets and specific measures, we are doing our part to help achieve the objectives of the Paris Climate Agreement that all countries have got into now. But in doing so, we are strengthening our position as a preferred technology partner and a supplier of sustainable solutions. So having said that, with this, we have now taken a self-imposed target that Schaeffler Group would become a climate neutral company by the year 2040. And this objective covers the entire supply chain and underpinned by the ambitious midterm sustainability targets. And the targets that you see in terms of sustainability would encompass the 4 areas of environment and energy, customers and products, employees, and also the suppliers and the materials as well. Having said that, clear matrices, KPIs are being fixed already, and we would like to continue to keep the focus on this journey. So what does this mean for Schaeffler at an India level? I move to the next slide, which is going to talk about our impending journey on ESG, which is going to address predominantly the 4 target areas that we talked about. And clearly, we have now framed a strategy on the way forward, and our strategy should be ESG-led, and it should be approached in a holistic manner. And all the business areas would address this journey on ESG. So currently, we are in a situation where we are formulating the ESG strategy and implementing the roadmap, and various steps involved in the process. First is to define the ESG purpose, which has been done. The second would be to do a baselining and then frame up a strategy and the roadmap, which we have just now started. And the third stage would be where we get into an implementation mode. And then we would get into disclosures and reporting and communication to all the concerned stakeholders. Having said that, we have identified some of the areas where we believe we would like to focus on going forward through a materiality and assessment that we have carried out. And we are now in the process of fixing the vision and target, what you see on the right side. Going forward, we would also look at various areas to transform Schaeffler in India in the area of capital planning and workforce planning, operations management, and that would be leading to disclosures wherein we would be talking a lot about what are we doing. It's not just about what we do and achieve, how are we achieving these things. And that's going to be the key focus area going forward as well. Having said that, I would come to the last slide of my presentation, wherein I would like to summarize that we had a strong quarter and a calendar year performance across the businesses in our diversified portfolio. And the performance improvement has happened due to better mix, definitely, and also our sustained effort on the countermeasures that we had laid down at the beginning of the year, which we continue to keep the focus upon. And also the focus on ESG as a journey. We aspire to align our environment and social targets to develop a strategy clearly addressing the risks and opportunities. Now, having said that, we will continue to sustain our performance while dealing with the challenges and some of the risks that we see on the horizon as such. And with that, I come to the end of my presentation. Thank you so much. Over to you for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vimal Gohil from Union AMC. Please go ahead.
Thank you, sir, and congratulations on a very strong calendar year. So my first question is on margins. In the backdrop of rising raw material costs, and we have seen most of the companies across the board have suffered on gross margins, whereas you show a completely opposite trend. So just wanted to get your sense on what has led to this very strong gross margins, and the related to that would be if I were to look at your OPEX this quarter, which is that has grown at a slightly faster pace than usual, and it is now at a run rate of more than 200 crores. It used to be 170 crores just 2 quarters back. What has led to that increase? Just wanted to get your sense on overall margin performance, whether this is sustainable, not sustainable, etc. Thanks.
Yeah, thank you for the question, Satish Patel here. As far as your question about the margin is concerned, for the quarter, as we also have mentioned in the presentation, there are actually 2 contributors to the margin improvement in the quarter. One is the improved mix. We had better performance of revenue in exports. The exports grew significantly during the quarter, and we also had significant good performance in our businesses of aftermarket and distribution business. So these businesses actually have margin profile better than other businesses and actually contributed in terms of the better mix to the extent contributing the margins as well. The second contributor for the quarter is the countermeasures that we had initiated since about 2 years, since the pandemic, onslaught of the pandemic. Those countermeasures we could sustain, and the full realization of quarters of the countermeasures actually realized in Q4. So that in a way helped improving the cost position. Our cost discipline enabled that, and that also contributed to the margin improvement. As far as your question about margin, also to the extent of the steel prices concerned, is very valid. There was a significant increase in the steel price, anywhere from 30 to 50% in the respective input of steel. However, a large amount of this steel price impact we could mitigate either by recovery from the market or by internal measures, because we have initiated as part of our countermeasures also several projects on the material cost side by instituting certain actions like alternate material, alternate sourcing, and those actually also contributed in terms of the compensation of those impacts. So all in all, contribution from all these aspects, and that helped retaining as well as improving the margin position in the quarter, that is Q4 of 2021. The impact of the countermeasures that I actually talked about already had since beginning of the year, and therefore for the full year also, if you see even the preceding quarter, which is Q3 as well as the first half, the performance in terms of the result was quite better. It further improved, no doubt, in Q4, but the initiation of the countermeasures that we had on the cost side, since those were laid out early enough, about 1.5 years back, that helped achieving the margin position on a strong note already from the beginning of this year. So that's the main sort of reason. Now, coming to the connected question, is this sustainable or not? Yes, to a large extent, yes. And I would not say everything would be possible to sustain. As far as our countermeasures are concerned, and this we had also mentioned in our earlier earnings call, that about 40 to 50% of the measures that we take are sustainable. So most of the countermeasures we are hopeful of sustaining. Material projects also would continue to contribute in the future. And the steel price, as nobody knows which direction it will move from now. But whichever direction it moves to the extent, there would be corresponding impact also on the side of the recovery. So that's in nutshell also about sustaining the margins. Yes, we have the balanced business portfolio that also in a way helps ensuring that our margins are sustained. And we put our actions on the execution side. The execution this year actually was very, very effective, and we hope that we would try our best to continue those actions also going forward.
Sir, in your OPEX?
Another question for some 200 crore and 100.
Yeah. So the OPEX number, this has now come to almost 206 crores. This used to be about 170 crores in Q2. So if you could just help us understand what has led to the sharp increase in the last 2 quarters and how will it trend forward?
Yeah, so on the capex side,
the OPEX, I'm so sorry. It is the OPEX number, the 206 crore other expenses that are there in the P&L.
Right.
Yeah. So what has this number used to be about 170 odd crores last in let's say Q2 of CY21. If you could just help us explain what has led to this increase, sharp increase in the other expenses.
Yeah, so some of the expenses are in the outside services area where we had certain services actualized in the last quarter. There are also certain expenses which are because of the performance in the quarter were approved. There are no specific reasons of relative increase in the expenses. The expenses have gone up, no doubt, in absolute terms by about 30 crore. But there have not been any, let's say, relative increase in the expenses. The fixed costs more or less have remained fixed. I do not see any particular expenses that significantly gone up. Yes, those outside services which have been actualized in the last quarter, that's the only area where the expense has gone up. Otherwise, on most of the other expenses side, there have not been any increase. Another expense, which is the CSR expense, which we were required to accrue, and the large amount was required to be accrued in the last quarter. So that was another expense which was actually higher in the last quarter. So a couple of them, yes, increased. Otherwise, most of the expenses have remained relatively at least level. Those were there in the preceding quarters.
Sir, if you could just highlight what exactly would these outside services be and how much was the CSR expense in this quarter?
CSR expense was about 6 crore as I see. 4 crore, other way around, it was 11 minus 6, so 4 to 5 crore. And outside services should be about 8 to 10 crores. Yeah.
So what are these outside services?
Those are all contracting out services, contract labor services, IT services, the quite varied nature of services.
Right. Sir, and next question would be to Harsha, sir. Sir, if you could just help us explain or rather give your commentary on what is the traction on the gasoline products that we had introduced post, the seemingly high pressure on our diesel products, diesel-related, engine-related products. And if you could just help us, where are we in terms of the content per vehicle in bearing? And more important question is the ever important question on electric vehicles. How much of our portfolio, or rather what exactly are we doing to shield ourselves from the inevitable electric vehicle advent?
Okay, let me first take the first part of your question, which is more on our efforts to develop products for the gasoline application. As already shared in the earlier meetings as well, that we are continuously bringing in products to cater to the gasoline market, and as more and more cars and vehicles are coming in with gasoline engines, our product offerings have increased. Having said that, the proof is when you look at the industry itself, if you were to look at the passenger vehicle industry in the fourth quarter compared to the preceding quarter, it just grew by 1.9% in terms of vehicle production. Having said that, our growth was definitely significantly in double digits, much better. So truly, our actions in the gasoline technology continues, and we will continue to build on it, and which is going to definitely raise the content per vehicle. and currently we are in the 40s already, 40 euro per vehicle, content per vehicle, in that range. And we see increases happening in the second half of this year, as some of the projects which I shared in my presentation are going to start scaling up in terms of demand and volumes, which is going to happen now. So some of the, like cam phasing systems that we have launched, this is all going to start to materialize, and we see the content per vehicle set to only grow. So that's on the gasoline versus the diesel. Talking about, you had a question on the electric vehicles, right? Yes, currently, if you were to look at our percentage of, the revenue we generate out of the e-mobility sector, that is pretty small. It's just about 3%. These are products which we make for the electric vehicle application, primarily on some in the passenger vehicles and some in the two-wheelers and three-wheelers. But we have clear strategy as well as plans to play a bigger role in this game of electric vehicles. Three areas which we are aggressively pursuing is one on the electric motor, the second is on the motor control units, and the third is on the thermal management systems for the electric vehicle applications. All the three we are focused upon, and work is going on, and we are already engaging with some of the key customers, and we will definitely share with you as the products get rolled out into the market. We will certainly bring visibility to that as well.
Thank you. I would request Mr. Gohil to rejoin the queue for follow-up questions. We would also request participants to limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Priya Ranjan from HDFC Mutual Fund. Please go ahead.
Yeah, hi. A very strong set of numbers, so congratulations on that. So first on your business mix, if I look at the reporting numbers, so there is some element of industrial also in the automotive side. So what are those areas, and can you just bifurcate? I mean, is it like say two-wheeler or tractors or trucks, which are all you consider inside the industrial segment of the automotive mobility business?
Well, the way we are structured is, mainly based on the product ownership per business area. The products which predominantly go into the two-wheelers, being bearings, ball bearings, they are within the industrial ownership portfolio. But there are products which are also under the automotive. So we do the business from the automotive side of our business vertical in the two-wheeler space. So some of the products like the needle roller bearings that go into the cab applications of two-wheelers, some of the one-way clutch products, and a few others which are under development would be coming out of our automotive portfolio as well. So to clearly demarcate and say that two-wheeler is clearly bracketed under industrial would be incorrect. There is some percentage of the business that happens from the automotive side as well. That's the first thing. The other thing is when you look at even the same would apply to the tractor segment, because tractors too are part of the businesses with industrial and a part of it is with automotive, because the clutch and transmission system products, they are owned by the automotive part of the business. The bearings is owned by the industrial part of the business. So, both the businesses. So for accounting reasons, it's easy for us to maintain it within the business vertical and track the performance.
Okay, got it. And the railway is also considered under mobility?
Well, railway is considered under mobility, but it is in the industrial space, so to say. The entire business and the product ownership both.
Okay, understood. And so, sir, I mean, in terms of broader mix, like say, what was the contribution from say four-wheeler and trucks and two-wheeler side in the current fiscal year 21?
Exactly four-wheelers and two-wheelers, such sort of classification is not available because we take our automotive business into engine business, transmission business, chassis systems in those sort of segments and not in vehicle segments. But I can give you some heads up as regards two-wheeler business. That is about 8 to 9% of our total business. And if you talk about only industrial within that two-wheeler business, would be almost double of that, which is 16 to 18%. Off-road would be about 3 to 4% of the total business of the company, and of the industrial business alone, it would be about 6 to 7%.
Okay, understood. And passenger side, I mean, four-wheeler used to have roughly 25%, 1/4 of the business used to come earlier. So that will broadly remain same, or that is going to, that has also changed with the content going up?
Actually, that we believe will go up. Again, it depends. Now, if one were to look at the Q4 performance, the passenger vehicle sector itself has slowed down, so the demand went down. But the commercial vehicles did well, and we are now increased our business in the heavy commercial vehicle segment with our clutch offerings, the 430 millimeter dia clutches. So having said that, so you may see some shift, but more or less it's in the same range of 20-25%, what we talked about.
Okay, got it. And the one good performance was on the export side, so 70% growth. Can it continue for a couple of years? Because even if I look at your number, it's roughly still around 14-15%, but I mean, I guess your target was roughly around 20% export, if I'm not wrong. So can we expect this kind of growth continuation for next couple of years?
Well, our strategy has been clear right from the beginning that we would be making a lot of investments coming into India only for exports as well, primarily coming on the back of the cost competitiveness that we believe is in in India, and also the knowledge and intellectual capabilities that are there here. So we would want to leverage both and make India the manufacturing hub of some of the specific product lines. India is going to be the only country which is going to manufacture these products. And so this is a clear strategy we have, and next 5 years certainly we're going to continue to make more investments, bring more products, and products are getting shifted from European plants to Indian plants, and that is going to continue. Satish, you want to add?
Absolutely. I think very nicely laid out, Harsha, and as far as investments as far as exports are concerned, now it is an integral part of our strategy, and rather we are actually having a specific focus on exports in terms of investment. So we are expanding our capacities for specific products which are export oriented, and particularly products like taper roller bearings, large size bearings, stack bearings, terrol bearings, CRBs, and one-way clutch. In erstwhile times, we had focused for CRBs largely for exports, but we have expanded the portfolio and actually covered all these product segments. And there are opportunities, including opportunities for DGBBs, which are actually category of the ball bearings, in other parts of the world, specifically in Asia Pacific region.
Yeah.
So we have strong growth potential in Asia Pacific as well as in America, in addition to continued growth in Europe region. And there have been sort of focus for certain specific product development in India, precisely because of the reason that Harsha talked about as regards the engineering, R&D, and in addition to that also the cost competence. I think we also have the cost competence in India, and the products are of best of the quality, well accepted, well experienced, and well tested. So that actually offers lot many opportunities. And India is one of the strategic focus country of production within Schaeffler Group. And therefore, Schaeffler Group focuses for sort of some of the strategic relocations also to India, to Schaeffler India. That brings further opportunities of growth in exports. That is one of the reasons the exports grew by 70%, and we are looking forward a quite good growth in exports going forward.
Thank you. I would request Mr. Priya Ranjan to rejoin the queue for follow-up questions, as there are several others waiting for their turn as well. And we would also request participants to please limit your question to 2 at a time. Thank you. The next question is from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi. Good evening, sir, and thanks for taking my question. Just a couple of clarifications. So one on the passenger vehicle side, like you referred to some of the emission norm changes and the regulatory changes that are happening. So how will that sort of impact your business on the automotive side? And again, related to that, we are starting to see some meaningful shift towards CNG also. So will that be a neutral for us, or will that be positive or negative? If you could shed some light on that.
Thank you, Mr. Gupta. Well, let me start when the transition began to happen from the BS4 to BS6. And rightfully, the emission norms got stringent, and that definitely posed some challenges for all auto component manufacturers, and Schaeffler was no exception to that either. But having said that, with the engineering competence and capabilities that we have, we were able to come out with products which would meet the new emission standards, and thereby we began to consolidate our position. Now, one of the shifts that we saw from the BS4 to BS6 that happened was a clear switch from the diesel technology to the gasoline technology. Now, having said that, we were very strong on the diesel engine applications with a wide product portfolio in India. When the change happened, and it happened pretty fast, we were able to quickly shift gears and bring products from our European, technology centers into India to feed the gasoline need that came up. All in all, we have also started to localize the manufacturing of them in India as the volumes began to pick up. So, if I have to summarize, as the emission norms become more and more stringent, which it will, surely our products are capable, because our products definitely have to address friction, which is one of the biggest deterrent to efficiency of the application. And that is where the friction reduction is, it's engineering and science, which is where we have the capabilities, and we bring that to the table to improve on the existing solutions further, to generate more value for our customers as the norms become stringent. So we are fully geared up to meet the the CAFE norms, which is already happening, and also the BS6 phase 2, which is being implemented right now.
Sorry, and just on the CNG portion, is that will that have any negative or positive impact?
Well, we do not see any negative effects here for the products that we make, which go into these applications. There could be some customization required in some of the products, which need-based we are able to and willing to address them as they come up.
Got it. And my second question was on the automotive aftermarket. So clearly, we've seen a very strong growth for the year. So is this more of a normalization, or how do you see this going forward? I mean, like in terms of your focus on the aftermarket, and I believe we have been expanding the product portfolio as well. So if you could just talk about the aftermarket business.
Mr. Gupta, are you referring to our performance in the aftermarket or the industry?
For Schaeffler. Yeah.
Okay, thank you. So, as you know, last year we did launch the Schaeffler 2-Power brand, under which one of the products we launched was the engine lubricants oil, and that was the first time we got into engine lubricants as a business. While yes, this is more a traded activity for us, but we are working with credible partners to bring quality products to the market. Now, having seen the response from the market, which has been phenomenal, we didn't want to stop there, and we have now expanded our offering, going beyond the engine lubricants to brake fluid oils, to engine coolants, and so on and so forth. That is on the oil as one of the product lines. But apart from that, as you have seen, we would continue to bring in more products under our Schaeffler New Automotive Products, or SNAP, which is an acronym that we use internally, to launch more products on our trading portfolios. That is clearly one of the strategies for the automotive aftermarket growth that we have envisaged. Having said that, we are also now seeing a lot of opportunities as the vehicles are coming into the market with the BS6 conforming vehicles. we see the need to upgrade the automotive aftermarket products as well, which were earlier hitherto conforming to BS4. Now they would see wear and tear and they would have to be replaced. So we see some replication of the products happening into the new, needs, norm needs that are coming in. As well as we see some opportunities where we were not participating, like the heavy commercial vehicles and the light commercial vehicles, particularly in our clutch portfolio, which we have now started to add products there as well. So what it means is, while we are already working very closely with our OEM customers and enjoy bringing a wide portfolio to the OE customers, we want to replicate that in the aftermarket as well. And that is the second strategy which we are clearly working upon.
Got it. Great, sir. Thank you so much for taking the question.
Thank you. The next question is from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Yes, good evening, and thank you for the opportunity. So for one of the questions on margins, you did mention that exports and aftermarket mix did help your margins. Could you kind of give a sense on maybe if you could just rank the key segments that you have in terms of the order of higher margins, like exports, aftermarket, followed by some of the other segments? Could you just give a sense of which are the segments with the highest margins and probably the ones with the lower one?
No, very difficult for us to spell out or sequence our sectors into highest and lowest margins. But yes, we can certainly confirm that the margin improvement was the result of the cost discipline, countermeasures, and the revenue mix. And even within auto also, there are sectors where we have high margins, low margins, depending upon the risk in that sector. So it would, in my opinion, not be appropriate to rank the sectors in terms of margins, highest to lowest. But yes, it is obvious that aftermarket margins are better than OEM. Right? That's the standard way of looking at the sector. But that's the main reason for the margin improvement. Yeah.
Right, and despite increase in say traded products, like now you've started shock absorbers as well. So you think this margin profile of the aftermarket will continue to remain strong?
Yes. Yeah, that's right. That will continue because we offer solutions, right, which are very progressive, and actually that is going to add value to the offerings that we are providing to the market.
Right. Understood that. And just my second question is on railways. I think last quarter when you had given a commentary on various end markets, you kind of called out that railways were still quite weak. So just want to understand, is there any change there in the outlook for railway segment?
There are two things here. One, railway is a tendering business, as you know. So as the tenders come out, we would be able to play the game as well. And fortunately for us, in the Q4 of 2021, some tenders did come up. We were able to execute them as well. So we definitely saw, almost a 9% growth in the railway compared to the preceding quarter. But yes, we do have some gaps in our product portfolio, and currently our products are still going through. They have very long homologation lead times, and currently we are going through that process. But we have a clear strategy to get back in the game soon, and you will see that our railway business definitely would start to play a bigger role in the entire game of things.
Right. All right, sir. Thank you so much.
Thank you. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah. Hi, good evening. Congratulations on great set of numbers. Couple of questions from my side. Firstly, on the CY22 norms, if you can highlight your content per vehicle, how that will get impacted, which is at 40 euros, and you had guided earlier it will be between 50 to 52 euros going forward. Does the target change materially with the CY22 norms coming in, or was that guidance given pertaining that? If you can share one or two examples of new products, that will be helpful.
Okay. First and foremost, to answer to your question on the content per vehicle, as I mentioned earlier, we already moved to gasoline engine product portfolio, which is now dominating almost 85 to 87% of the market is gasoline, and we are already there. So having said that, our product offerings definitely are already conforming to the current emission standards that have to be met, and we will continue to improvise as the CAFE norms come in as well. So what we see is our content per vehicle is only set to grow going forward. Yeah, and I'm currently resting only on the IC engine portfolio, correct? And while this is happening, we are also looking at opportunity to grow in the LCV segment, where hitherto we were not very focused, but we have increased our focus, and we see some good growth stories going to come in the near future as well. So content per vehicle would certainly grow, and the current portfolio, what we have, would need engineering tweaking, which we have the capability to do as we move forward, and we will do that. Yes, the electric vehicle is another ball game where the content per vehicle would dramatically go up, but the volumes still have to come into the Indian market for us to play the game on the passenger vehicle side of electric vehicles.
So the clarification there was, with that 52 euro per vehicle number is sustained, or would you up that guidance given these norms are coming in?
Well, it will sustain. We will continue to sustain this.
Got it. Second question was pertaining to the industrial mobility segment. We saw a very strong growth here, and particularly railways, which is a key part of this segment, you mentioned has not grown materially, or there is still some weakness. So if you can highlight the key components, what are there in that particular sub-segment, which is shown the strong growth of 33% on a year-on-year basis.
I would like to start by first classifying the railways into two. One is the pure railways and second is the metros, okay, the city metro trains. Well, when you look at the city metro trains, our position is very strong. We have a good growth story to tell. Where we have to do still some more work is on the trains, particularly on the passenger locomotives as well as the freight trains. That a lot more is happening due to the government trying to bring down the logistics cost as a percentage to the GDP. Clearly, the freight cars are the focus areas, and that is where we are looking into how do we play the game there as well. So we are working on some of the projects, key projects for the railways as well to come back into the game. But metros, we already are strong, and we would like to consolidate and continue to build on that position there.
Okay, so that is metros has driven the growth for industrial mobility. Yes. All right, thank you so much.
Thank you. The next question is from the line of Shyam Sundar Shriram from Sundaram Mutual Fund. Please go ahead.
Yeah. Hi, sir. Good evening. Thanks for taking my question, and wonderful performance yet again from Schaeffler. So, if I may start with exports per se, you did talk quite a bit on that. Just if we look ahead into 2 years, can this portfolio become a 1,200 crore kind of an annual portfolio per se, or if you think in terms of our revenue mix, can this start contributing 15% of our revenue mix? And in our capex, do we also are the lines that we are investing specific for export product lines, or these lines fungible between export and domestic depending on how the demand moves? That is my first question on the export side, sir. I'll come back with another on capex there.
Yeah, so good questions. As far as exports concerned, we already sort of talked about that. We would focus on investing for the products which are actually export driven and which are actually required to be focused for the exports. So our capex goes definitely for exports, but our equal focus as far as capex is concerned is also for the domestic market and domestic requirements. And we have laid out about 1,000 crores of capex over 3 years that we already announced last year. This year there was sort of a capex we had targeted, and we are little short of that. there is little overrun to next year, so we would ensure that next year, which is the current year, 2022 calendar year, some increase in capex we are planning. But with that, yes, I do confirm that our focus to spend and to invest appropriately to be future ready will continue to be there both for the domestic market as well as export market. And when I say domestic market, it is not only just extending or expanding the capacities, it would be more of a qualitative capex because we want to actually increase the footprint of manufacturing and localization. So localization is equally a focus area. We had localization below 70%, we are now 75%, and we are targeting to exceed 78-79% in that range for localization. So capex goes for all these sort of areas, and that will continue to remain. Your second part of the question was regarding the mix of the exports. I would request Harsha to please take up that.
Shyam, just to give you another perspective on the investments we are making for exports. The products which we intend to produce here and export out of India, as you know, India too needs those products, and currently we have been importing them. So with the investments we are making for the export market, what would happen is obviously we will become more cost competitive by making the same product here in India to fit the Indian need as well. So we see a dual advantage here. One is to capture the export market and grow the market, and also leverage the cost competitiveness and gain more market share within India as well. So it helps us both.
Absolutely. Yeah. Very good comment, Harsha.
And directionally, can this export portfolio touch 1,000 to 1,200 crores on an annual basis in say 2 years?
It's very difficult to actually, sort of spell out, but we are expecting the improvement in the mix. So export was around 10-11%, now 13-14%, and likely to improve further.
Thank you. I would request Mr. Sriram to rejoin the queue. The next question is from the line of Sachin Maniar from InCred Research. Please go ahead.
Hi, sir. Congratulations for good numbers. So within the industrial portfolio, as you highlighted that industrials within mobility has grown by almost 40% QQ, but within other segments there has been down by 37%. So can you see which are the laggards in this quarter? Is wind was one of them, and what with the going forward, how the wind market you look in the way it is going? That's my first question. And how will the share of industrial aftermarket and wind for the full year CY21? That's my first question.
Okay. Sorry, Sachin, the first part of the question was not very audible. If you can repeat that, please.
Yeah. So, as I say, in the industrial segment, within the mobility has grown by 40% QQ, but the industrial segment within other segment has degrew by almost 37% QQ. So, which are the laggards which has impacted this quarter in the industrial segment? Is wind was one of them?
Okay. I think, I would like to just make, clarify here. For example, one of the sectors for us which has seen one of the strongest growth is the wind energy, correct? And we have seen a growth over the previous year almost to the extent of 116%. Very strong growth there. Yeah. And another sector also which has grown is the industrial automation sector, where almost 100% growth we have seen there. Phenomenal growth.
Year-on-year growth.
Year-on-year growth. And also, when you look at the industrial aftermarket or the distribution part of the business, where our clear strategy was in place to grow that, there again we have grown phenomenally, much higher in double digits. So clearly the non-mobility sector as well has shown strong growth, particularly in some. Yes, one of the sectors where we can definitely do better is on the railway, which is the mobility sector, of course. Even the raw material sector, we have definitely seen a double-digit growth rate in our business performance as such.
Okay. And sir, can you break up the auto part into engine, transmission, and wheel end for the full year in CY21?
You mean the growth or the mix?
Mix, sir.
The mix should be about within automotive.
I think.
Yeah. Just a moment, please.
Try and see.
how much.
Okay, Sachin, to answer to your question, if you take the automotive application, we normally classify them as engine system, transmission system, and chassis system, correct? And if you take the engine system comprises almost close to 14-15% of the total business we do. And the transmission system, no, but this is at the country level.
Yeah, so out of the total company business, company system is about 13-14%. And if you take automotive alone, it would be almost double of that.
Yeah.
So it's about 25%.
25%, and the transmission is about 25% of the total business. Yeah. And the chassis system comprises roughly about 6.5% of the total business.
Yeah. But we have to almost double for automotive business.
Okay. So just last, wind, what will be the share of wind for the full year in overall revenue?
Share of?
Wind. Share of wind.
Wind?
Yeah. Wind market.
In the total game of wind.
Yeah, in total close to 10%.
Close to 10%.
Okay, thanks. Sure, thanks. That's right.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to Ms. Gauri Kanikar for closing comments.
Thank you, Margaret. Thank you, everyone, for joining us today. If you have any further queries, please do reach out to me on gauri.kanikar@schaeffler.com. With this, we conclude the call. Thank you, and have a good day.
Thank you. On behalf of Schaeffler India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.